Welcome back to Boss Economics World, where we tell it like it is, no sugar-coating, no bureaucratic nonsense. Today, we're diving headfirst into the belly of the beast, central banks. These faceless technocrats that many folks barely knew about before 2008 have been running the show, our show, while we're busy working, trying to keep our heads above water. Central bankers went from tweaking interest rates like clockwork behind the scenes to becoming the so-called global economic heroes, poking their noses into our wallets and, in many cases, driving us all into an economic abyss. Remember this, the 2008 financial crisis was a turning point, a flashpoint that threw central bankers into the spotlight like never before. Suddenly, the heads of central banks, people like Ben Bernanke, Mario Draghi, and others, weren't just economists, they were the avengers of global finance, fighting to save the world from the chaos they, helped cause. You had Fed Chair Bernanke fumbling around with policies that made asset owners rich, while the rest of us were left counting the cents in our pockets. And Europe's Mario Draghi? Sure, he swooped in to do whatever it takes in the Eurozone, words that not only rocked markets but also fed into the growing wealth gap everywhere. The fallout of the 2008 crisis wasn't just an economic downturn, it was the dawn of the technocratic elite ruling with even less oversight. Now, central bankers aren't just central bankers anymore. Mark Carney, a man who once ran both the Bank of England and Bank of Canada, decided to dip his toes into politics, running to replace Justin Trudeau as the head of Canada's Liberal Party. Wait, what? Yes, you heard that right, the guy who used to decide whether your mortgage rate went up is now asking people for their vote. Then there's Andrew Bailey, the current head of the Bank of England, he's taken to TikTok to explain policy to the average Joe. Dumbing it down wouldn't be the issue if it weren't for the fact that the policy is giving you less money to spend at the grocery store, and explaining it like a cute dance challenge on TikTok isn't going to help you when inflation is crushing your paycheck. Folks, pay attention here. Our economy is being run by bureaucrats with practically zero accountability, and worse, they're embraced like folk heroes for dishing out policies that have accelerated inequality level, expert. Let's get one thing straight right out of the gate. While these technocrats were propped up as crisis managers saving the day, it was the working class who footed the bill, bearing the brunt of decisions that never bore their interests in mind. In the meantime, the wealthy saw their portfolios fatten as central banks flooded the world with easy money, raising asset prices and making homeownership for regular folks as distant as a fairy tale. One of the loudest and most controversial clashes in recent years has been Donald Trump and the Federal Reserve. Trump fired off on Twitter, criticized the Fed, and kept calling for lower rates, something that would have juiced the stock market in the short term and made his re-election prospects rosier. But this isn't just about Trump, folks. Trump's push to control the Fed sounds a lot like Turkey's Recep Tayyip Erdogan. If you don't already know, Erdogan's hands on meddling in Turkey's central bank left the Turkish economy wrecked with soaring inflation and zero credibility left for monetary policy. What's wild, though, is that Trump wasn't just some loose cannon. Across the political aisle, you had Bernie Sanders and Elizabeth Warren criticizing the central bank, claiming that monetary policies had helped turbocharge inequality. And they're not wrong. Since the 2008 crash, we've seen an explosive growth of inequality, widespread asset bubbles, and rocketing house prices. All this has fed the pockets of asset holders while everyday folks have struggled with stagnant wages and rising costs. Leah Downey, an influential thinker, recently threw her hat into the ring, asking one simple but radical question: why on earth do unelected technocrats control something as critical as our money supply in a democracy? Think about it, central bankers have more power than most of the politicians we elect, and no one asked you or me whether they should. Their decisions impact everything from the price of milk to your retirement savings, yet they're accountable to no one except their own ivory towers. Let's rewind the clock here. Central banks weren't always like this. Take the U.S. Federal Reserve, for instance, established in 1913 to prevent financial panics. It was not some financial castle sealed off from the people, but a compromise between private banks and the government. Back then, the Treasury Secretary even chaired the Fed's board. As World War II came around, the Fed was dragged into holding down interest rates to fund the war effort. It was only after the 1951 Fed Treasury Accord that the Fed gained more autonomy, more independence, and less oversight. In the golden era of so-called central bank independence, economies hummed along without much public objection. But here's a question for you: who benefits from emphasizing autonomy? Spoiler alert, it ain't the working class. The independence these guys were gifted with became a marginalizing tool. Central banks, designed to be regulators with occasional interventions, are now fetishized as all-knowing, all-powerful institutions with carte blanche over our lives. Their decisions are supposedly too complicated for the masses to understand, so we're expected to sit down, shut up, deal with high prices, and somehow thank them for keeping inflation in check, sort of. Downey points out the key flaw here: leaving so much power in the hands of unelected officials is one giant middle finger to democracy. Why? It allows politicians to shirk responsibility while outsourcing economic decision-making to a bunch of technocrats who aren't held accountable when their policies hurt ordinary families. According to Downey, instead of letting these economists rule over us like financial overlords, a healthy democracy would involve regular reviews of the Fed's mission, a kind of central bank checkup. Should unelected individuals continue to handle the levers of money creation every time without asking the people? Downey doesn't think so, and neither do we. She takes it a step further. She's got radical ideas, like giving Congress a bigger role in determining where the money supply should flow, enforcing ways for elected officials to scrutinize Fed policies. Gone would be the days of them nodding along with whatever magic elixir the central bank deems appropriate. They'd actually represent your interests. Imagine that. But of course, all this talk about central bank democracy has its critics. Economists overwhelmingly support the concept of an autonomous or independent central bank, you'll hear, and that's true. They argue that central bank independence correlates with lower inflation. Maybe that's true historically, sure, but look around. Tell me that inflation hasn't come roaring back with central banks still at the helm. Structurally, the problem isn't day-to-day operation battles over interest rates, it's about who gets to set the grand strategy. Grab the nearest economist, and they might say central banks need to stay independent to keep political influence out of monetary policy. Here's a newsflash: central banks never were, and never will be, free from politics. Whether it's handing cushy policies to Wall Street or ensuring housing prices remain astronomical, the politics of economic oligarchy are baked into the structure. They are simply the politics of privilege. Look, the world isn't the same as 1980 when governments feared inflation like the apocalypse. Since 2008, asset bubbles and inequality, not inflation, have been the central problems. But when inflation does pop up, as it has recently, the caped central bankers always seem to miss their mark. So, we have to ask, can we really let this small cadre of unelected financial elites continue to call the shots? After the big mess of 2008, central banks became even more powerful, and here's the kicker: they've fumbled the ball on more than one occasion. Let's talk about quantitative easing, QE, the massive chucking of cash into financial markets to support the economy. It sure sounds nice, until you realize this just stoked asset prices and lined the pockets of those with stocks, bonds, and real estate. Everyone else, the folks who don't have extra savings or investments to fall back on, well, they got dizzy watching house prices rise far, far out of reach while wages stagnated. Since 2008, asset prices have skyrocketed. In the US, between 2012 and 2022, the S&P 500 surged up 159%, while personal income growth lagged at just 45%. Home prices inflated to nearly double their pre-crisis peak, leaving millions locked out of homeownership, a so-called American dream now reserved for the top-tier asset holders. And after the dust of the COVID economic shutdown settled, the conundrum only deepened. Central banks, again rushing to fix market slumps, unleashed another round of practically free money, pushing inflation through the roof. Now, the same class of technocrats who said everything's fine in 2019 are backtracking, scrambling to hike interest rates and slow the beast they helped awaken. You tell me how this cycle benefits democracy. Listen, we're not asking for a witch hunt, we're calling for reform, for oversight. Leah Downey's right on the money, pun intended, when she warns against unchecked power. Without some democratic accountability, our central banks continue to run our lives as unelected technocrats, influencing everything from housing to jobs to inequality. And the consequences? The pandemic exposed the already fractured system to the core. We've now got inflation in resurgence, homelessness rising again, and central banks both tightening and loosening monetary policy in convoluted cycles that solve little for the person who isn't knee-deep in financial jargon. What we need is not just talk but action, real democratic oversight on these powerful institutions. We're already seeing the dangers in India, Thailand, Turkey, everywhere central banks become the playground of powerful men trying to cling to their own power. History is littered with countries where central bankers fumbled their trust, and people should no longer stand idly by. So here at Boss Economics, we'll keep asking the tough questions. We'll shine a bright light where the bureaucrats prefer darkness. You deserve to know who's really running the show and why it's time for we the people, not they the technocrats, to get more say in how our economies run. Stay tuned for more hard-hitting takes. And remember, if there's an epicenter for economic mismanagement, look no further than the nearest central bank. That's it from Boss Economics World today. Thank you for tuning in.